All right, ladies and gentlemen, thank you guys so much for tuning in to a special edition of our YouTube show with the one and only David Hunter. Now, it's been a while, it's been a few months since we last spoke with David. We had him on our YouTube, and we had a really nice, long, and detailed discussion on his market outlook in a general sense. And when I say general, I don't mean to diminish it because it's very comprehensive and it's also very bold. And I will say this, credit where credit is due. Mr. Hunter presented us with something that it appears is starting to potentially play out. Now, time will tell if the prophecy actually fulfills, and we do, in fact, get the melt-up theory. But last time we spoke with David Hunter, the S&P 500 was, multiple hundred points lower than it is right now. Now we are experiencing a ever so slightly, pull back off of our highs so far, but markets do tend to have a way of ebbing and flowing before they ultimately reach their final sort of peak, or I guess dip. In this case, with Mr. David Hunter, we'll be talking about the potential peak or blow off top that is to come. So, Mr. Hunter, thank you so much for joining us again today on our YouTube show. We greatly appreciate you delegating some of your time to us this morning. I'll ask you what I ask everybody. It's tradition here on this channel. David, good morning. How are you? What are you seeing in the markets?
Yeah, hi Max. Thanks for having me. Thanks, Wabi, for having me. This is an interesting time, I think, because we've obviously had a couple weeks here, as you say, that we've had a pullback. I'm not sure if I said it on your show, but back around 4,200, I was saying probably back close to 4,000. I was saying we look like we'd have a run to 4,600, maybe a little higher, and then have a pullback that could be as much as 10%. As we got closer to 4,600, I said that still could happen, but I think any pullback here may come in under 5%, that it might be less. So it's playing out that way right now. We're 2 weeks in, and I think there's a pretty good chance we are either done or very close to being done with the pullback. And I think the next run takes us to new highs. Whether it just keeps going from there and becomes a melt up, or whether we have to pause there, I'm not sure. I would lean towards this thing could really get going. But at least I think we've got to run from here to new highs, 4,800, 5,000. Maybe a small pause there before we go, but I think we're basically about to see the melt up begin. And not, it's been confusing. People think the melt up has been in place since the lows back at 3,500. And I said, well, we're in the new bull leg. But the true melt up, the true parabolic, probably doesn't get started till we see new highs and people start giving up their bear market rally story. So I think, this whole rally, as you know, people have been fighting it. And I think we're going to see, as it moves to new highs, the narrative switch to, hey, this is a bull market. Fed tightening is coming to an end. It looks to me like China's at a point where they have to start going the other way, that their policy turn is here. So, and we may see that kind of domino through the world. Europe's probably behind us, certainly, but I think at some point their tightening cycle's got to end because their economy's not doing well either. And I think you're going to see that's going to be really part of the fuel for the melt up. Maybe a good part is the fact that the tightening headwinds are now turning into the end of tightening tailwinds. And as I've been saying, I think that takes us to 6,000 on the S&P, maybe 7,000 on the S&P, and 20,000 on the NASDAQ. I have a 48,000 number for the Dow, and I think that's going to prove low. The Russell to 3,000, I think that's going to prove low. So these are big numbers, and of course, right now most of the street thinks the market's already overvalued. So it's hard for them to get why you can have that kind of a run. But if people start thinking we're coming into a new cycle, that this is 1982 or 2003, and that there's a cycle ahead of us, you start looking at your earnings out in 24, 25, and 26. And there's a rationale there that can take this market up. And of course, positioning has been bearish. Yes, people have as the tape, as I said, the momentum of the tape has pulled people back in, but most have been fighting it and saying it's, it's a bear market rally. So they're not fully in. Positioning is still defensive one way or the other. And I think it's that repositioning from a crowd that can move the market very fast. And so, although the narrative may be that we're starting a new, a new big bull market, a big bull cycle, I view this as a final leg to a secular bear market, or a secular bull market that started back in 1982. So I really think this is more of a, blow off, melt up, blow off, either one, that happens in a vertical way.
Yeah, well said, David. Thank you for all that. And it's interesting that you mentioned this sort of this potential dip that we're seeing into a rip up to 4,800 or 5,000. I wouldn't exactly call myself a proponent or an advocate of the melt up. I, of course, entertain every possible scenario, and I love hearing this one from you because you're able to articulate it. And for one, you've been trading probably 10 times as long as myself for investing. So, of course, it would make sense to hear your theory out, especially how it's actually started and it's potentially in the very early phases of actually melting up. But from a more active trading perspective, which I'd say that's really sort of the basis of our business, we're all very active, sort of in and out of the market, day trading, sometimes scalping. A lot of the people that actually tune into this show are pretty active as well. It's a lot of, I'd say the demographic is mainly like 18 to, 30 younger people, that they're newer to investing, sometimes can breed a more active investing style or pattern for the better or for the worst, depending on who it is. But one level that we've really been monitoring as we are dipping right here is that 4,300 level or the August 2022 high. Now, we spent, a very prolonged period of time. Once we dipped under 4,300 last year, we basically spent like, half of a year, 3/4 of a year sort of accumulating. And our thesis right now on a higher time frame is that there's a pretty high probability chance from a technical perspective, and I guess fundamental as well, seeing as nothing is really broken, from all of the rate hikes, that 4,300 should act as a pretty strong level of support. So if we dip, maybe from where we're at right now, another 150, potentially 200 points, we would expect that level to hold as a pretty solid demand. And if history is any indication, you mentioned 4,800 to 5,000. The S&P 500 has repetitively done this pattern that we spent a lot of time focusing on, this fractal, where you'll have a big drop, over 1 year, 2 year, 3 years, and then you'll actually slowly climb back up, make a new all-time high. So that would imply maybe 5,000 or so for the S&P 500, and then maybe another dip following that, and then we can reevaluate. But it seems to me that if the melt up is going to actually sort of culminate and manifest and happen, this 4,300 level, maybe 4,250 at the deepest, should be that level where we could expect the dip to stop and then sort of manifest into a spring or a rip.
Yeah, I wouldn't rule that out, certainly. I think, again, within that context of a 5 to 10% pullback, I think that's very possible. Right now we're looking at a 3% pullback. I would also not rule out, however, that we came right down to a trend line here on both the Nasdaq and the S&P and bounce right off it. So time will tell, and it won't be very long. I mean, I think you just have to see how this week plays out. But I would not be surprised if we've had our correction. The amazing thing is to see how quickly the sentiment turned. How many people, as soon as, and I see it, I keep saying I should create an indicator based on my Twitter feed, because I am the bull in the market and have the aggressive upside. So I have the minute the thing turns south, and that's funny because back at 3,500, I was an idiot. What are you talking about? Run to new highs and ultimately a melt up when we know we're going lower. It turned there obviously last October, and all of a sudden at 4,300, I had a lot of people pat me on the back and saying, "I'm sorry, I shouldn't have been calling you an idiot and stuff." But
Isn't that funny how that works? Isn't
yeah,
that's
it's kind of
funny how
funny
that
how
works?
people all of a sudden you're an idiot and then you turn into a genius, But that's sentiment driven by the tape, and But what I've seen recently is just, this 150 point pullback in the S&P, and all of a sudden there's a lot of doubters again saying, your melt up's crazy. It's not going to happen. These are the same people that, 3 weeks ago were saying, I get it, I see it. So again, that's retail sentiment, but I think you're seeing the same in institutions, that they do view this as a bear market rally that's probably coming to an end, and they are looking for downside, whether it's back to October lows, new lows, or halfway back there. There's various views out there, but I do think that just a pullback of this magnitude has created a lot of negative sentiment, and what I call the wall of worry that provides the fuel for higher. So I certainly don't rule out 4,300, but I would also say it's very possible that with everybody sitting around waiting for lower, that this thing may have already done its pullback.
Certainly. And David, just one quick question for you on something that you said, and I didn't know that you did analysis like this, but you mentioned trend line. How important is technical analysis, such as, maybe either diagonal or horizontal trend lines or fibs, or really any sort of TA in your thesis?
Yeah, as I say, when people say, well, how do you develop your forecasts? I go, they're based on technicals, fundamentals, macro, um, cross markets, and sentiment. So it's all of that together. I do look at charts for sure. I don't, try to pretend I'm a true chartist, or I don't do point figure or anything like that. But I think trend lines do matter. I think you can see places where there's support and it will bounce off that support. I certainly pay attention to those kind of things.
Yeah, very cool. All right, well, I'd love to get the other guys in here involved in the discussion. Let's kick it over to Tommy first. Tommy, you got the mic, man. Anything for David or any comments that you'd like to share?
Yeah, for sure. Hi, David. Great to speak with you again.
Yeah, hi,
It's
Tommy.
pretty funny.
How are you?
Uh, Great. Yeah, no, things have been going great in the market. Like Max said last time we kind of touched base with you, it was basically like pre-breakout from that 4,200 level on resistance on the S&P. So, yeah, no, super glad to have you back. And yeah, I think from the standpoint of just kind of what we've seen this year, I'd love to get your take on whether or not, yes, we have traded higher ultimately, but is there anything that you think um, that kind of surprised you throughout this process, or something that you didn't expect, even though the thesis so far, up to this point has proven to be, a very effective one?
Sure. Well, certainly the length of time, the cycle is stretched out. Not just the market cycle, but the economic cycle has stretched out. And I would have thought by now, I've been a broken record in terms of being critical of Fed and saying that what's going to ultimately lead to the bust that follows a melt up is a huge policy error on the part of the central banks, particularly the Fed. And I think they are committing a huge policy error. I think they've overstayed their welcome on the tight side for many months, and I think it's going to come back to haunt us. But surprisingly, what's the story of the summer? The story of the summer is, we're moving from a hard landing concern to soft landing. Then maybe some people saying no landing. So it's been surprising in terms of real resilience of the economy. And when you look at it, it's probably shouldn't be too surprising given the amount of stimulus that was pumped in 2020 and 2021, both monetary and fiscal. And I think that's what we're seeing is just kind of the fact that there's still a lot of that sloshing around. And we live in an economy, we live in a country where it's still shop till you drop. The consumer just doesn't give up easily. I think we saw this summer a little bit that they backed off on some of their material purchases, consumption, and they moved their discretionary income over to travel. And, so it's not that they have this huge pot of gold that they can draw from. It's that they have to kind of move it around, but they don't want to give up their lifestyle. And so I think that's coming to an end at some point. We're seeing delinquencies rise in credit cards, and we're seeing signs of tiredness in the housing. Obviously, rates are, mortgage rates are unbelievably high for most people who are trying to get in there. So I think this is going to play itself out in coming months, but right now it's causing the narrative to switch to more of a, instead of worrying about a bust, they're now saying, hey, maybe we skate through this without a real recession. And that's not my view at all. And I think in the next few months that probably switches back. Ironically, while the street's seeing that, the Fed's shifting back towards maybe a lot of our work is done. They're not ready to, call it mission accomplished. But I think ironically, they're not getting upset by the stronger numbers in the economy near term, because I think they see they're making more progress on inflation. So I don't know what they're going to do in September, but I think we're really very close to the end of tightening, at least for now. I do have a thesis that on the other side of that tightening, you're going to have a bump in commodity prices. You have probably, if mortgage rates come down, because I am calling for lower interest rates, you're probably going to have another bump in housing. I wouldn't be surprised if, and with the market, if I'm right and you get a melt up, I wouldn't be surprised to see Powell and the Fed come back at S&P 6,000 and say, we got to tighten, this thing's breaking, this thing's getting way overheated. And so you may have a pause and then tightening again as we approach the end of the year.
For sure. And then I'd love to get your opinion on through all this, right? Because equities have shown, just absolutely insane strength basically all year. But the market that I love to trade is crypto, and it's Bitcoin. But we haven't quite had the same, we'll call it speculative fervor in those markets, right? We've had, we've had the on-chain markets, and I guess some more granular levels of crypto that have been, producing outsized returns for investors. But as a whole, Bitcoin moved, the first quarter this year, and it's been going sideways for essentially 6 months. So how does Bitcoin fit into your melt up thesis? And do you think that, Bitcoin maybe waits to run in a potential commodity super cycle, or do you think that it's, more likely to correlate to a melt up in stocks?
Yeah, I don't really follow Bitcoin. I can offer my opinions, but they aren't worth much. I will say, I know people got very excited earlier this year and tried to draw this correlation between the market and Bitcoin. I kept having people come into my feed and say, yeah, your melt up is going to work for Bitcoin too. And I'm not sure that's true. It's had its time when it's correlated, but it's not always. And I think we could see it deviate, but again, it's not a strong opinion because I don't follow it. And my longer term view is, let's see how it holds up in the bust. That's one of the reasons I've stayed away from crypto. As I've said, I really want to see it get through a full cycle. And with the cycle ahead that we're, with the bust that I think is coming, which is, biggest downturn and biggest market implosion in post-World War II era, let's just, it's a good test. Let's see how it holds up. And, what comes out of there, if Bitcoin holds up well in that, maybe I'll take a look at it. But I just think it's too new. I don't like a lot of the speculative fervor that surrounds crypto. Maybe I'm just a dinosaur, but it really isn't. People think it's me making a judgment on whether it's a good investment or a bad investment. For me, it's really just I've chosen to say it's not really something that I need for my macro call. And I just need more seasoning to it to have any real feel for it.
I think as far as I'm viewing it, it's either going to be one of those things where you just see kind of it perpetually lags stocks, or I think you kind of see it catch up all at once. Probably, and I can never pronounce this word correctly. The breadth within the crypto market is probably going to be smaller than what we saw in 2021 just because of a lack of liquidity. But I do think there are still going to be opportunities in that market, especially if legacy stocks can really I think achieve this melt up, this, I mean, 5,000, 6,000 prices on the S&P, I mean, significantly higher prices on the NASDAQ as well. I think it's either going to be one of those things where you just perpetually lag, or yeah, you catch up in probably one quarter, given the market's appetite, potential appetite for risk.
Yeah, for sure. Crypto seems to be, and particularly Bitcoin seems to be very momentum driven. So if you get it going, we saw it last time we're into 60,000, it can get going. So I don't dispute that, but it's hard enough for me to follow equity markets. I don't need that one.
Yeah, it's a 24/7 market, so it definitely keeps you on your toes. But I appreciate your insight, David. It's very helpful.
So, David, one quick transition I'd like to discuss with you is some of the activity that we're seeing in yields, and then of course translating over to bonds. We're seeing tickers such as TLT, long duration Treasury bonds, basically in free fall and capitulating right here. There's been a lot of narratives circulating around sort of Twitter and even some national high profile news outlets that the U.S. debt is going to be downgraded and bonds are not sustainable and don't touch bonds, and price is sort of following that narrative, or maybe the narrative is following price. What do you think about bonds at this juncture in time?
Yeah, good question. Part of my reason why I think we may be seeing bottoming in, or an end to this pullback, is because I see so many things kind of coming into the same vortex. I think that the bonds are basically retesting the March lows or interest rate highs. So I am very bullish government bonds, and actually the whole bond market looks like it's bullishly positioned. I think you're going to have my call, which I had probably, I don't know if we talked about it last time, but would have had back then, is that we're going to see 2.5% on the 10-year during the melt up. So whether the melt up is between now and October, or between now and the end of the year, that's a big move in the bond market if we see the 10-year go there. And I think the 30-year probably goes down to 290. And my call beyond that is in the bust, we're going to see new lows on interest rates. So I'm looking for 0% 10-year.
Wow.
Maybe negative rates on the 10-year. This is next year. And the 30-year down to a quarter or a half. And obviously short rates down into negative territory. I think the Fed doesn't want that, but they're not going to have a choice. And so, I mean, I think we're at the high water mark for rates for the next couple of years, or certainly next year plus. And my TLT call, I have a target on TLT in the bust. Again, that's not this year. That's it's a horrific global downturn, deflationary downturn, which I'm calling for to follow the melt up. I'm saying TLT can get to 200. So you're at 95 now, or 95-ish now.
Yeah.
That's a huge move in a government bond proxy. So, but that just tells you, I think everybody's worried about inflation right now, right? Everybody's concerned that it may heat up again, or the Fed hasn't done enough, or the Fed's going to have to the Fed's certainly worried about it, going to have to stay high for longer. And my view is the seeds are sown for deflation. They have stayed too long on the tight side. The leverage in the system is massive. And, the leads and lags on Fed policy are, as they say, long and variable. They are wanting to see 2%, their 2% inflation target before they ease. That means you're a year too late in easing. I mean, that's just, they're waiting way too long. So what I think is going to play out over the next several months is that the economy gets weaker. It just keeps getting weaker, that the leverage in the system makes things continue to deteriorate. And ultimately we hit a place where things really break. So But my view here is that sentiment on bonds is rock bottom. It's very bearish. Um, I see signs that this is a retest right here. Doesn't mean you can't tick up a few, more basis points, but I would not be surprised if this is the low water mark for bonds. And surprisingly, corporates have held up well. You would think, with all the worries, that you'd see the corporate spreads widen, right? And not even the junk spreads have widened. So I don't. I think this is more emotion driven and narrative driven, and that's a classic retest.
It's interesting to hear you mention retest because I would consider myself more of a TA focused investor rather than FA. And one observation that we've noted here on this channel numerous times, we've been following TLT since this Fed tightening cycle actually began. But every single like global bottom or high time frame bottom that formed in long duration treasury bonds was a double bottom, if not actually a triple bottom. So when you say retest, it really aligns almost perfectly with my bias that we're coming back to retest that capitulatory low around $90 on TLT. Maybe we deviate it slightly. Maybe we hold there and get a true double bottom. But either way, you're right. I mean, sentiment around, government debt in any form right now is terrible. There's a lot of, as we call it in the crypto world, FUD, fear, uncertainty, and doubt. I mean, the fact that people are actually debating seriously on national television, whether the United States government is going to, default on these bonds or whether they're actually, like a good investment because they're talking about, downgrading the U.S., credit rating. And it's all this stuff that, I mean, it seems so far-fetched to me. Like, well, I mean, in the simplest of terms, the U.S. can continue to print money. Our money is backed by the strongest military in the world. It's like, what are we really talking about here? What's going to cause them to not, fulfill these debt obligations? So I totally agree with you. I mean, sentiment is in capitulation right now.
Yeah, it's interesting because you do have, excuse me, you have the whole, BRICS meeting coming up next week, and supposedly a new gold-backed currency, and the end of the dollar as reserve currency is a narrative out there, etc. So there's a lot of things out there where people are kind of taking the bearish ball and running with it, and that's what I mean by everything's kind of coming to a head here all at once. I mean, you look at the metals look like they're forming a very big bottom, not a minor bottom at all, a very big bottom. And I think the dollar's just completed a counter trend rally and is about to roll over. My target on the dollar for the melt up is, and we'll be on the melt up, is 80. So we're at 103 and change, and I think it can go to 80. That's a huge move. The other currencies I think are setting up for big rallies, including the yen, euro, British pound looks really good. The Canadian, Aussie both look a little bit troubled right now, but I think they're just kind of going through their final sell-offs before they rally. So I when you look at currency, interest rates, stock market, they all just seem to be coming into a place where I think you could see a complete reversal. And yet, and I'm a contrarian, but as is common at bottoms, everybody's looking the wrong way.
So, Dave, one point I'd love help kind of understanding the timing of this this potential rotation, or even like synchronicity between bonds performing well and also equities entering, this true melt up past 5,000 ideally. So, and I want to just kind of lay this out. You can correct me if I'm wrong or not understanding it correctly, but I want to kind of understand how they work in tandem together. So it's your thought that the Fed is going to begin cutting rates sometime next year. That will, of course, cause, bonds to skyrocket in prices, potentially sending TLT upwards of, 150, 175, 200 potentially. And at that same time, once the Fed starts cutting rates, you're still anticipating a melt up from there in equity valuations. And the reason I'm asking for, no, you're not. Okay.
No.
Okay.
Yeah, my call is the melt up is immediate. So
Okay.
yeah, the reason I call it melt up is you may cover 3 years worth of returns in 3 months.
Okay. So
So in
the
other words,
equity
if
melt
you
up is going to happen well before the bond melt up.
this
Okay.
year,
Okay. Okay. Okay.
and then that melt, and as I say, that's a final blow off to a 41-year secular bull market that started in 1982, and I date it back to there. I'm seeing a few people that are starting to talk that, use that date. When I started talking about this years ago, nobody believed that was the beginning of the secular bull market, and everybody thought it started in 2009 or it started in the 2000s, 2003. No, the reason I used 1982 is because that's when the huge disinflationary trend began. That's when interest rates peaked at 15% on the long bond or the 10-year, either one, and moved down to 40 basis points on the 10-year, in 2020. So it was, and ultimately I think one more low from there. So it was tied in with the bond market and disinflation, because a big part of the move in the indexes has been PE multiple expansion from single digits back in 1982 when inflation was so high and interest rates were so high, to where we have high double digit, 20 times earnings type PE multiples, and ultimately I think higher than that in this melt up. And it's all tied into the disinflation. The next cycle is, once we get through a deflationary bust in 2024 and early 2025, the next cycle is inflationary. It's a beginning of a long inflation cycle that ultimately peaks out much higher than I think early 1980s. That does the opposite. That then squeezes multiples. So I believe we're setting up for the final run here into a secular top, the highs of which will not be seen again for decades. So in other words, if the S&P gets to 7,000, we won't see 7,000 again in the next 20 years at least. And if the S&P, if the Nasdaq gets to 20,000, you won't see that number again in 20 years. In spite of AI and in spite of all kinds of other things, because you're going to have high interest rates and shrinking PE multiples. So I think this is truly a kind of monumental end of cycle story.
It's it's like the grand finale, right, of the fireworks show. But it's also very ominous, right, to imagine a scenario where we see the S&P 500, go on a tear from here, wherever it bottoms out on this little pullback, to potentially significantly higher. But there's also a great opportunity to create generational wealth. If the rotation that you're describing happens and we see the S&P 500, go to looks like why am I showing up twice here? Okay, anyways, I think we lost Wabi.
Twice is good.
There's two of me. Okay. Yes, just ignore the second me. Sorry, I guess Wabi left and it threw the stream off. I'll correct that when I'm done here. But the opportunity for generational wealth, potentially to ride the S&P 500 to 7,000, and then from there, sell your equities, rotate into like long duration treasury bonds, which could pull another 2x from there, sometime next year, would be maybe a once in a lifetime opportunity. I will just say this. I've got one final question for you, then we'll go over to Tommy. I see he's got his hand up, and then I have to figure out how to get my second camera off stream because Wabi's not here anymore. Hey guys, you mentioned that we might not visit, a new all-time.
If you guys can hear me, I'm still here. I'm not sure why I'm not appearing, because on my end it appears that I'm here. I'm not sure if you guys are able to hear me.
Okay, yeah, no, we can hear you, but your camera's not there. So, David, I'm curious where where do you see after this blow off top? Where's your price target for the collapse or the drawdown after 7,000?
Yeah, great question. That my expectation, I've been saying this for a long time, is that following this melt up, you will see a bear market that has potential to be 80%. So peak to trough 80%. So if the S&P goes to 7,000, you could see 1,400 on the S&P in 2024. That's, I mean, that's, and so it sets up this conundrum because you could have, like I said, as much as 3 or 4 years worth of returns happen in a few months. And right on the other side of that is risk like we haven't had in our lifetimes. You know, the Dow dropped 90% in 1929 to 31 or 32. So this will be not quite as big as that, but it'd certainly be the biggest broad market decline in the post-World War II era. So you've got the potential for a big reward right in front of you, but you know, obviously I don't know that will happen. That's my forecast. So it's it's an unknown, but it's possible. And right behind that, the potential for this, huge decline and huge risk. So it's a conundrum in terms of, and I'm not, I don't provide any advice, make any recommendations on how people should play that. I just caution people, for those that say, hey, I'm going to be defensive because I can't be that nimble. Just understand the nature of psychology is that if you get a run here of 50% type run from here, maybe more, you're going to have a hard time fighting that. You're going to fight it beginning because right now it doesn't look like nobody really believes that. But as you get closer to the top, there's going to be a rationale that follows that tape that's going to be very compelling. Like I said, it'll probably be some narrative along the lines of this cycle has a long ways to run. It's just beginning. The Fed tightening cycle's over, and you've got several years of a new cycle ahead. It'll be something like that. And people will be thinking I'm wrong on my bearish call, just like they think I'm wrong on my melt up call. So know yourself as an investor, as a trader, in terms of your ability to fight the crowd, because at the top, the crowd's going to be very bullish and all in. And I have been a contrarian for 50 years. There are very few people that I've seen in my career that are comfortable being outside that kind of a dominant crowd. I'm very comfortable with it. That's what I like. But most people really have a hard time. They can be contrary for a little while. They can be contrary under certain circumstances. But when the whole crowd has a compelling story, it's not easy to say I'm going the other way. So it's really just say know yourself, know your personality, know your ability to fight a crowd, a consensus view. And on the other side, on the downside, I mean, it's the reason we can see that is simply because it's been decades of excesses building. And I think we're at that point where, I mean, with 300 trillion in debt out in the global system, leverage just really can take you down. And as I say, derivatives are leverage on the markets, debt's leverage on the economy, on the system. Derivatives are another form of leverage, and they're leverage on markets. And we have quadrillion the notional value of leverage, notional value of derivatives. Never been here before. We've never been in a down cycle where we had anything close to the level of derivative exposure we have today. That can whip a market around in a hurry, and will. So, between debt and derivatives, I think it's easy to see why this thing can get going. Probably, it's not going to go peak to trough in a straight line. You'll have, you could have like a 40% decline, rally back halfway, and then another big decline or something like that. But just know I think it's going to be fast and furious.
It certainly would be something. It definitely would be. It's pretty freaky to think about that happening, but enough for me. David, thank you for that answer. Let's kick it over to Tommy real quick, and then we're going to go to Wabi right after that. Tommy, what do you got for us?
Hi, I was just just kind of basing it off of your description of how you think this is eventually, going to resolve as far as markets and the economy go. Have you drawn any comparisons between the current state of the United States economy and really just situation um, to Japan in the 1980s and 1990s when they had their massive bubble? And as you mentioned, we might not see an all-time high for maybe 20, 30 years. That's basically what the Japanese stock index is experiencing right now.
Yeah, back in that's a great question. Back in the late '80s, I was with Fidelity as a pension fund manager. I wasn't on the mutual fund side, um, and I went to a luncheon in 1988, I think it was, following the '87 crash, um, and there were pretty much all the big portfolio managers in Boston were there. There were like 25 of us sitting around a table with, I can't remember, it was Merrill Lynch or who sponsored the lunch, but basically went around the table and wanted everybody's view. Where are you guys? And of course, the 1987 crash had happened. So the majority, I would say, out of 25, let's say 24 were bearish the US. A couple were kind of neutral, but the rest were pretty bearish the US. And almost all of them were bullish, or I'd say more than half of them were bullish Japan. The others were, I'm not sure about Japan. It's extended, but I think Japan's, got a long ways to go. I was the only one that was extremely bullish the US and very bearish Japan. And of course, that was a year before the top, but Japan topped out a year later and obviously hasn't come close to that since. And that's pretty much what I think we're looking at with the US here. I think we are Japan of 1989 or 88, 89. And so, yeah, I think, it's a good analogy, probably the best analogy in the post-World War II era of where we're at as a country right now, or where we are as a market is, yeah, I think, we've done a lot to hurt our future in terms of how we're managing our government, how we're managing our fiscal situation, how we're managing our monetary situation. I mean, and basically even in the private sector, when you look at consumers and what they've done, there's a lot of excesses that I think are going to come back to haunt us in the next cycle, probably the next several cycles.
Yeah, great.
Definitely
Thanks,
agree
David.
with
Let's
that
kick it over
statement.
to Wabi, get some thoughts from him. Wabi, what do you got for us?
Hey, what's going on, guys?
Yeah,
Unfortunately, what's up, man? Fortunately, I can't be as enthusiastic as I usually am. Currently recovering from a sickness. It's kind of weird, man. But David, man, I actually wanted to go back on a topic that I brought up to you during our first call, and that was about the Nasdaq bubble in the late '90s, right? So when we look at the current model with M2 money supply and inflation adjusted, during our last peak of the Nasdaq at 16,000, we actually did a double top right to the 2007 peak, and right around that time it was 2,800, right? And in order for us to break the dot-com bubble high, the Nasdaq would have to surpass 30,000. And I wanted to ask you, right? It's a pretty straightforward question. Do you believe that the Nasdaq is eventually going to break that high? And it kind of goes to show how crazy that Nasdaq bubble truly was, right? You could have just thrown a dart at any tech stock that appeared on the news, and you'd be up like 10x in a matter of weeks. I guess we can start off like that, and I do have a few other things to touch upon.
Yeah, you're right. I mean, the Nasdaq bubble was, and obviously that was the last parabolic we saw. We haven't had a broad-based parabolic probably since when, maybe 74. But the Nasdaq was, the last parabolic, and it was unreal in terms of where people, just threw money at it. Took second mortgages out on their house to buy .com stocks, and stocks that had no earnings and no prospects, but they had .com in their name and they just threw money at it. So I mean that's a tulip bulb type of phenomena. I'm not sure I follow the 30,000, how you get there. I can't visualize what you're doing, but I do. I have a target of 20,000, which will be nominally, an all-time high, right? By quite a bit, in terms of NASDAQ. So I don't know if you're looking at it in terms of a trend,
I'm looking at it through M2 money supply and inflation adjusted.
Okay, inflation adjusted.
Yeah.
Oh, okay.
Yes.
Yeah, I mean, I don't really look at that, but I doubt we get to 30,000 in this run. I mean, that'd be crazy. It's possible, I guess. This is a melt up, and that's what I say is once it goes vertical, you can cover a lot of ground in a hurry. So I do think we're going to certainly. I wouldn't doubt that we surpass my 20,000 target. 30 is a big jump. I would guess, and I think you're alluding to this. I would guess that .com bubble was from a inflation adjusted basis was a true excess we won't go back to. But either way, I mean, from a nominal standpoint, if the NASDAQ gets up anywhere near 20,000 or above, that's a huge run from here. And I think it's, again, it's target for likely this year. So,
David, and at the start of the year, right, we started seeing a massive trend, not only in the equity markets, but also the crypto markets, with things regarding, innovation such as AI. We even saw some EV stocks run, over the last couple of months. And I wanted to know, outside of what you're seeing in the indices, is there any particular sector that you're looking at to outperform the indices? And also, what is it exactly that you look for outside of technicals when analyzing a specific sector and a stock? I think that's very, very important.
Yeah, it's basically, to take that last question first. Technicals matter. I look at technicals. I look at where they are fundamentally now, but more importantly, where they fit into, the next year or two in terms of both the cycle, particularly cyclicals, and where I think expectations are going. So, it's not just what do I think the economy is going to do next year. It's what do I think the narrative is going to gravitate to. So that's why I think you're going to see, I think, a real broad rally in this melt up, with a lot of the value stocks, a lot of the cyclicals catching up, because I think what's going to happen is you're going to move to people seeing this as an early cycle move. Again, we're transitioning from a bear market, from a Fed tightening cycle to a new cycle. So I think you're going to see people buying autos and buying steel and buying copper and buying a lot of things, even though I'm calling for a bust next year, which would mean a lot worse earnings and a tough time for cyclicals. There's going to be a period of time in here where I think the narrative is going to shift to next year's a recovery year. So, those are the kind of things. A lot of it's, it's not always exactly earnings driven, but expectations driven. And in terms of sectors, I'll answer, in terms of AI and EV and stuff, I don't really look at EV closely. Obviously, it will continue growing through the decade. I don't think it's going away. I think it's way overhyped. I think the auto companies are making a mistake moving ahead of the market. It's kind of climate change is driving their motivation, the whole narrative about climate change, and the Biden administration's push. You look at the consumer surveys, and consumers aren't ready for electric cars. So I'm not sure that EV is going to meet the hype or meet even the auto companies' expectations by any means, but it's going to continue to grow as a segment. So I don't have any opinions on the stocks. AI, I will say about AI, in this melt up, I think AI will continue to play. So I don't think we saw obviously a big move in AI that drove the early part of this year. But I don't think that's the end of the AI excitement or the AI pricing move. So it will continue to play in the melt up. I'm very bullish semiconductors still. You know, I have a target pre-split SMH pre-split. I had a target of 200 or 400. It split 2-for-1, so that target's now 200. I raised that to 250, and I've said recently I would not be surprised to see 300. So that's which would be pre-split 600. That's a hell of a move, and again, that's just in the melt up. So semis I think still play very well. But I also think copper producers, steel. A lot of people don't realize it, but the industrial sector, you know, XLI ETF is basically at new highs or at the old highs, all-time highs. So, you know, for those that want to say this market has been driven by 7 stocks, they're ignoring the fact that home builders have had a great run. Industrials have had a great run. There's a lot of areas that have done well, and I think will continue to do well. So I think you're going to see a broad rally. Tech will continue to play, but value will catch up. I think that's part of the story for this run. Is there's still a lot of what I'd call undervalued or behind the curve areas of the market that can move. Everybody's focused on tech and thinking they're overvalued, but there's a lot of other areas that can help push this thing too.
David, and back in if you guys remember, back in October, we had Janet Yellen right when the S&P, I think it was during that CPI reading, we dipped to 34.91, and there was a headline that came out saying that Yellen was worrying about the loss of adequate liquidity in treasuries, right? And she was noting a surge in supply of treasuries, and she was basically saying that the Fed standing repo facility could help and things like that, right? So when we look at the drawdown, right, from the peak of just over 4,800 to, you know, just sub 3,500, you know, it's just your standard, you know, close to 30% correction in equities. And basically the Fed since then has been doing this form of silent QE, right? And if you guys remember what happened in March with Silicon Valley and all those other banks, you know, the Fed pretty much came to the rescue. And David, I wanted to know, you know, when that scenario potentially plays out with the bust, don't you think that the Fed would rush in to save the day if, you know, they would want to save the market, even if, you know, we go down 20-25%, they're usually going to rush in. And, you know, as we saw with the COVID crash, right, back in March of 2020, they will come to the rescue and basically prop up this market by any cost. I know it's a bit of a spicy take, but want to know your thoughts on that, given, you know, how rapid information is right now and how quick the Fed is to sometimes react to this when it comes to, you know, downside and, you know, these are narratives that really show how bad the economy can be.
Yep. Yeah, I think a lot of people would agree with you. They have a hard time seeing how you could see the market down 60, 70, 80% because, you know, the Fed has shown a proclivity to step in. And that's basically my thesis for why there's a recovery cycle following bust. Is I do agree that ultimately policymakers will, if given a choice between allowing something to just come apart at the seams or stepping in and saving the day, they're going to step in, right? They're not going to just let things collapse. So I agree that they're going to come in. The parts of this where I can get that 80% is number one. Like I said, if we get a market, let's say we get, you know, this is what's so strange about the cycle is the things I'm calling for. If they were stretched out over 3 years, I'd have probably more people saying that's possible if we're at the end of a tightening cycle, yeah, I could see, over the course of the next several years, a 50% move in the market. But I'm calling for it happening in a few months. If the Fed sees that, they're going to come back the other way. So even if let's say they pause this fall and they, for a meeting or two, they say, it looks like we're done. If we get a move over 6,000 on the S&P and the economy still is holding together, they're going to come back tightening, right? And then if the thing rolls over quickly sometime in the first quarter of next year, they're not going to just come right back and say, okay, we got to say, number one, their mindset, and they've been very clear since Bill Dudley spoke last April, a year and a few months ago, April 2022, about needing to get the market lower to tighten financial conditions. And he didn't put a number on it, but I think the general consensus was he wanted to see it down under, or the market needed to get, the S&P needed to get down under 3,000. And Powell bought that hook, line, and sinker. And for the next several months, every time the market lifted its head, he had his minions come out and talk the market down, right? It was very clear. He was running monetary policy based on the stock market in the opposite direction of what everybody had accused the Fed of doing for years, was propping up the market. He was trying to drive it lower, or at least keep it from rallying. And so that mindset is still there. You can tell the Fed still worries about the market, kind of keep taking the ball and running with it when every time they talk about, a pause in rate hikes. So imagine if we're at 6,000 or 7,000, the Fed's not going to have any interest in seeing the market up there. They're going to want it lower, or they're certainly going to be looking at that as one of the reasons why tightening may still need to happen. And so let's say we get a quick 30% sell-off, because I will tell you, once this thing rolls over, it could happen fast. First step down could be fast. If you're down 30%, they're not going to immediately say, okay, that's trouble, we gotta prop the market up. They're going to say, we're not here to manage the market, we're looking at the economy, and we're not ready, we're not going to tighten here, we're going to pause. But in other words, the Fed is not, I think they're going to be very deliberative and very deliberate in what they do. They're not going to move quickly and go one direction 1 month and the other direction 2 months later. So I think those all argue for them being slow to come back and support the market. And then let's say they do. They come back and they say, well, whatever it is, it might just be a quarter point cut, or it might be just rhetoric saying we're watching the market and we're certainly not going to tighten any further. Whatever it is, it might spur on a rally, trigger a rally. Then you get, let's say, a 50% retracement of that drop, and they see that and they step away again, and next thing you know, you're down 50% and going lower. By now the world's in a tailspin economically and financially. There's bank failures, etc. It doesn't matter what the Fed does or central banks do immediately, because there's a lag. Things are going to continue to get worse. So I think it's always hard to try to visualize when people have that mindset of the Fed's always going to come and stop. There's a stop on the market. It's hard to visualize how it can happen, but it can. So I could be wrong. Maybe we won't get anything close to that. But everything I look at says the potential is there, and the probabilities are not small that we're going to see a bigger decline in the market than we've had in the post-World War, at any other time in the post-World War era. And again, I'm not talking about one index like the NASDAQ in 2001, but overall, broad market movement. I think the potential is there.
David, and this is going to be some dubious speculation on my part, a bit fun that I like to have during these streams. So, Mr. Hunter, if you were Fed chair, right, if you were in Jerome Powell's shoes, what would be the things that you would be looking at going into Q4 and into the next year to prevent a bust, or do you think it's too late for a Fed chair to do pretty much anything to avoid that?
It's a good question, and I'm not sure I have a good answer. I do think a lot of the seeds are sown. I think the biggest seed that's going to, be added is the coming back and tightening again when the market's up. I think they're between a rock and a hard place. So I'll answer it this way. I I don't envy Paul's job. Um, you know, they get criticized a lot, and I've been very critical of them for being kind of a committee creating a camel out of a horse. But they really are trying. Traders think that the Fed should run policy like they trade, right? And just flip around when they see things going the other way. They need to be very steady as she goes. So when you look at it up till now, they should get a pretty good grade for what they've done because the economy hasn't fallen apart, and certainly I thought it'd fall apart before this. Um, the markets haven't fallen apart, even though they look like they were in a bear market last year, and all the predictions were for much lower. Um, yes, we had some regional bank troubles, but they kind of isolated those troubles and stepped in when they needed to pretty quickly. Um, the problem is a lot of the problems that build slowly and under the surface, and that's where I think they are making a mistake. Policy, the leads and lags, really a lot of the things you have to look at. Leading indicators are certainly pointing to real trouble. Consumer behavior is pointing to, or consumer balance sheets are pointing to some trouble. But it is a mixed bag because, I saw something where, there's a big percentage of homeowners. I don't remember whether it's 40% or 50%, but there's a fairly sizable percentage of homeowners that have no debt. Have no mortgage. So look at that equity in their homes based on the home prices. So there's a have and have not economy here, and it's not an easy job to kind of walk that line. Ultimately, I think what they're where they're going to fall, I think, and falter, and where I would hope I wouldn't, would be when this thing starts really turning south. Um, you're going to have to manage that very quickly, and I don't think they're going to. I think there's going to be some ziggings when you should zag, et cetera. And again, it's not just the Fed; it's also every central bank out there. And again, the wild card out there, and we're starting to see the problem surface now, is China. If we're in really bad shape, they're in even worse shape. So, and Europe's in worse shape. So I do think, my focus is the U.S., but I do think this is going to be a global bust with some other places suffering maybe even more than we do.
David, and it's interesting that you mentioned China. I'm aware that earlier this week they did some emergency cuts. Do you think that perhaps they're front running something that the Fed might do earlier this year to sort of set the stage for the melt up, or do you think the melt up comes like well before the USA even thinks about cutting?
Yeah, I don't count. None of my melt up is based on expectations of the Fed cutting. I think Fed pause is the best you're going to get, and I think the market will respond positively to pause. We had a pause in June, whether they wanted to call it the skip, which it ultimately turned out to be. But I think if the market smells pause, that's probably part of it. I really think it doesn't have to transfer over to here. I really think if you see China turn their policy, and it's begun, the big rate cut this week, I do think is a sign that they are realizing they can't continue to worry about excesses over there. They've got to worry about the fact that they may have gone too far. Like I said, they're more leveraged than we are. So I think that's going to trigger a turn in all the global markets. Is if China's such a big player out there liquidity wise, if they turn, that flows into the global liquidity story. And again, I think the Fed's pretty close to the end themselves. So just taking away the risk of tightening, or at least temporarily taking away that headwind, will be, China and US together will be, I think, a story that can drive the melt up. But just to be clear, I really think the melt up is a 2023 story, and likely could be over by the end of this year, if not sooner. So it's imminent. My only question really is, I haven't looked to see where the market is now, but if we are turning here, then the only question really becomes, do we have a small pause? Let's say you go to 4,800 to 5,000, pull back 100 points or something. I think this was your correction before the melt up. You could have another one, but I don't think it's any bigger than this one, and maybe smaller. So I'm saying the melt up's imminent. I think it's a story for September, October.
So, David, this will be my last question for you. We've been kind of going back and forth for about 20 minutes here, but I want to kind of circle it back to Bitcoin, not to show Bitcoin or anything like that, but in your traditional investing, you have companies like a Hut 8 or a CLSK CleanSpark, I believe the company is called, where people are able to benefit from the infrastructure of Bitcoin. And these companies, they have balance sheets, they have earnings, all that stuff that you would find in your traditional stocks. You're able to find within these companies. So I wanted to know, David, what are some things that you personally would like to see in order for you to, take interest in things like being exposed to the Bitcoin market industry, whatever you want to call it. As I know that your generation doesn't really pay much attention to this asset class, which is more driven towards millennials and Gen Z.
Yeah, just to be clear, it's not so much generational for me. Maybe it is some. I'm a dinosaur, but it really is the fact that it's so new and hasn't been tested. You guys are traders. You'll jump on a lot of things and not worry about the longer term, not consequences, but longer term, structure. And I just think the first thing, and this is long ago, the first thing that kind of turned me off to crypto and probably is still there, is a lot of the sponsorship was people that had failed as equity managers were over there touting the crypto. So it was a lot of the players. I didn't really like who was there. A lot of the hedge fund crowd that were there were people I didn't think that highly of their opinions. And then the whole retail, it truly was, it wasn't meme stock, but it truly was momentum. If it, you've seen it recently, but if there's not momentum, there's not nearly as much interest. So it was really driven so much by that. And then it was driven by this, and particularly Bitcoin, but driven by the idea that, the whole Austrian idea that central banking is bad and look what it's done. And this gets you outside of central banking, and, governments are trying to take your money, and this protects you from that. And and the dollar is going to lose reserves fast. All those things were out there that were feeding into crypto. And so, those are not the reasons I would want to be there. I'd want to see that froth taken out, or that speculation taken out for those things, because I think they're, wrong basis. I do think the dollar's in trouble second half of this decade, but it's going to be a gradual story, and it's not, it's not the Austrian story entirely, or it's not their timing. So those are kind of the red flags for me. And like I said previously to Tommy, my thing for me is I want to see it get through the bust. Let's see how crypto, and particularly Bitcoin, holds up in the bust. And then maybe maybe it'll be there. But as I say, I don't follow natural gas right now. I don't follow uranium right now. So it's not so much, um, you know, making a statement on its attractiveness. I will follow natural gas next cycle, and that's because I think the next cycle is a huge commodity cycle where natural gas will be a big player. But natural gas for me had too much of a weather component in the shorter run, and I didn't need it for this cycle. So I just, I follow oil for sure. So, Bitcoin's not, I wouldn't, or crypto, I wouldn't take as a statement that you know, I will say I don't understand it to an extent, certainly the technical side of it. But it's not really that keeps me away. It's that I want to see it tested in a true down cycle, which is coming, I think, next year. On the other side of that, I'm not sure where I'll be on it, but at least I'll have more history to judge from.
Yeah, it's something that I'm very curious about as well, David, is Bitcoin has only existed in frothy times. It's a very young asset, and crypto is a very young asset class. So the question is, will it do something like gold did during the 70s and sort of begin to act as a hedge against turbulent times or economic headwinds? And that's sort of a narrative that we see thrown around quite a bit, is that Bitcoin is digital gold. Or will it continue to sort of track global net liquidity, and as liquidity constraints continue to arise, Bitcoin's price will remain suppressed and sort of down in the dumps with global net liquidity? So I guess only time will tell. It's certainly a very interesting period of time for Bitcoin.
Yeah, I as I say, there's a Natalie Brunell, who is big in the Bitcoin space, interviewed me and has interviewed me several times. As I said to her in my last interview, my thing is that because she obviously believes strongly in Bitcoin and thinks it can be an answer to some of the problems coming up later this decade and certainly next decade. I'm calling for a total collapse next decade of the global system. My problem is there's such big macro events that Bitcoin can't solve between now and then that I think some people are putting too much faith in Bitcoin as an answer for. Yes, I'm in agreement that there's far too much government control and push for more government control, and getting outside that's great. I just see if you're talking about a global bust, something bigger than anything we've seen in post-World War II era, bigger than 2008-9, and then a huge inflation cycle far bigger than the early 80s, where you get to 25% inflation by the end of the decade, and then a total collapse of the system, and not just the US, across the world, total collapse. As I say, you could have 50% unemployment in this country with no welfare system, no unemployment system, no, government will be bankrupt, no, limited Social Security and Medicare, if any, a total collapse. Bitcoin's not going to solve that problem for you. There'll be maybe people outside the system, a limited small percentage of the population, that have Bitcoin and can say this saved me from something. But I don't see where Bitcoin is the solution for what I think is happening. We're at the end of a super cycle that began in the post-depression, the post-1930s era. We're at the end of a super cycle that I think is reaching its zenith by the end of this decade, and then a total collapse that will make the Great Depression look like a picnic. So I just don't see crypto as a solution for that.
The Great Depression looking like a picnic. Wouldn't that be something? You know what? Time will tell. That'd be that'd be scary. But you know what?
Yeah, I don't say it lightly. And by the way, just because we're probably close to wrapping up, I just wanted to say there is a cycle after the bust next year, and it's a big cycle for commodities. So as in every new cycle, you have new leadership. So this cycle has been technology driven, healthcare driven, et cetera. The next cycle is going to be very much industrial and commodity driven. You're going to have reshoring. You're going to have, Belt and Road around the world. You're going to have a lot of stuff going into, you're going to be bringing back semiconductor plants here, et cetera, steel plants, et cetera. So the next cycle is going to be very driven by commodities. I'm calling for $500 oil by the end of the decade. I'm calling for 20,000 gold, 500 silver. So
you said 20,000 an ounce gold?
Yep.
Wow. Okay.
So I think gold can get to 3,000 pre-bust. So that's a huge run here. And then go through a correction in the bust, big correction, maybe back to here. And then I think from there, 2025 to 2030, I think you can see 20,000. And because of what we're going to see in the bust, to pull us out of a global bust, we will probably see the balance sheet of the Fed grow from the current, 8.5 trillion, 8 trillion, to 30 trillion. So over 20 trillion, just and again, similar around the world, all central banks should be pumping money like crazy, just because you're at a point where you're going to have big financial failure. You're going to have to save a free falling financial system in that bust. That's why I call it a bust. And so they'll print money like there's no tomorrow, but it'll come, late in the decline in the stock market, and then it will, jumpstart an inflation cycle that second half of this decade will be, something we haven't seen in this country. It will surpass by far, I think, the early 1980s, and certainly surpass the last couple of years. And if you think about it, oil, for example, we've spent, because of climate change policy, ESG, we're forcing the carbon companies, the oil companies, to do less exploration, less development, and then we're going to print all this money around the world and ramp up demand, and development takes years, right? So you're going to have this supply demand situation where supply is far short of demand, and the only thing that can give is price. So that's why, and the same story for copper, the same story for, you go across all, basically all the commodity space, and it's going to be a case where demand far outstrips supply, and for a few years, price just goes through the roof. It will be, commodity cycles tend to burn out because they destroy the economy. If you get that kind of inflation, the economy goes the other way quickly. And by the way, think of the ramifications for the debt market and for the government. If I'm right, or anywhere close to right, you're going to have 15 to 20% interest rates on government debt. How do we manage our budget? That will eat up far more than our budget, right? So you won't have any money left over for military, for social programs, for anything. And so what they'll try to do early in the cycle, when rates are not that high, they'll be moving up, is they'll try to float more debt to help service the debt, right? They'll say, we need more money to do these programs. But at some point, very quickly, it's like pouring gasoline on a fire. The inflation just gets hotter and hotter, and the rates keep going higher and higher. And so you're defeating your purpose. It's outracing your ability to raise money. So you get shut out of the capital markets very quickly. And that's why you ultimately collapse, because, we won't be able to service our debt. And again, I speak of the US, but this is a scenario that will go across the globe.
I've heard sort of murmurings, or people talking about that online. It's sort of like the everything bubble, so much debt. You talked about the derivatives market being so substantial, compounding that with all the debt that we have, rising interest rates. It could really be a recipe for something that we've never seen before. So with that said, David, we do have to wrap up the show. We've been going for about 80 minutes now. I just want to pass it to you one last time. If there's anything that you'd like to end the show on, of course, we would love to have you on again in a few months just to check back and, again, continually sort of check in with you to see how this melt up is actually, culminating. But David, any final words for the audience?
Yeah, I alluded to it before, but just real quick, we didn't talk too much about the metals, and I do think it's been a very discouraging area. Both silver and gold have, every time you think they're lifting their head and going, they pull back again. And when you stretch it out and have a big perspective, look at a long chart, I do think you are coming to a major bottom here, and I mean major. And I think the dollar is going to be the key for this first step up, this move in the next 6 or 8 months. I'm calling for gold to 3,000, silver to 60 before the bust. So next 6 to 8 months, I would say. And so it's easy to get discouraged because it hasn't been able to get out of its own way for this year and for quite a while. I would just tell people that's the nature of the metals. They can really knock you down, and you throw in the towel just at the wrong time. So I do think metals are going to turn here right with the equity markets.
Well, there you have it. David, thank you again so much for spending your morning with us. Guys, thank you so much for being here. What a loyal and awesome audience. Thank you guys for tuning in and supporting us as always. If you guys enjoyed the stream, please consider liking the video, subscribing to the channel, and also give David a follow on Twitter. We will link his Twitter down in the description below. Definitely worth a follow, definitely worth tracking, what he's seeing in the market. So, David, I want to thank you again from the entire Because Bitcoin team and community. Thank you for spending your morning with us, and hopefully we will connect again in a few months, and prices are significantly higher.
Thanks, Max. Thanks, guys.
Thanks, David. Take care, everybody.